I have lived long enough to see markets invent the same sin under new names. In one decade, the language is homes. In another, it is telecom, then it is internet traffic, then it is cloud. Now it is artificial intelligence. The costumes change, the machinery underneath does not. When a crowd wants very badly to believe in a future, Wall Street does not ask whether that future is already earning a return. Wall Street asks a simpler question: how do we finance the dream, mark it up, spread the enthusiasm, remove the visible risk, and keep the loop alive long enough for everybody inside the system to look richer than they really are? That is why I do not begin this conversation by asking whether AI is real. Of course it is real. It will change labor markets. It will change how software is written, how data is processed, how medicine is practiced, how advertising is sold, how factories are run, and how governments monitor populations. Real technology can still sit inside a very dangerous financial structure. In fact, that is usually when the danger becomes greatest. The easier it becomes to hide bad financing inside a good story, that is the point most people miss. They keep arguing over whether AI is a bubble, as though the whole matter begins and ends with a chart of NVIDIA, a revenue multiple on some model provider, or a clip about robots replacing office workers. They are looking at the bright part of the fire and missing the fuel being poured behind the wall. What I see is not a simple bubble. A bubble can rise because prices outrun reality, that is common. But a bubble still suggests something that can deflate, reprice, clear, and eventually settle into a lower level of sanity. What I see here is more dangerous. I see a capital structure that behaves like a black hole. Money goes in. More money is required to justify the first money, then more physical infrastructure must be built to defend the story around the second round of money. Then accounting assumptions are stretched, so earnings look healthier than the economics really are. Then private capital moves in to finance the concrete, steel, cooling, land, and power. Then government steps closer because the story becomes strategic. By the time the public recognizes that returns are less clear than the headlines, the capital is no longer liquid, no longer easy to unwind, and no longer sitting in one place where the truth can be seen quickly. That is not the same thing as a garden variety bubble. That is a system that can keep swallowing capital long after common sense should have interrupted it. If you want to understand it, you have to stop staring at the promises and start tracing the loop. The public sees OpenAI, Anthropic, ZAI, ChatGPT, Claude, Grok, and the rest of the consumer-facing products. They see NVIDIA and AMD as the shovel sellers. They see the cloud providers and data center operators as the middlemen making the whole thing run. That part is true. It is also incomplete. The real story begins when one company funds another company in a way that circles back into purchases, commitments, anchor orders, or infrastructure dependence that benefits the original funder. The transaction is framed as strategic partnership, ecosystem development, accelerated innovation, national competitiveness, or platform alignment. The economic purpose underneath is often much less poetic. It is demand support. It is confidence manufacturing. It is a method of making future expectations look like present strength. A simple investor hears that a chip company is investing in an AI lab. He imagines a patient owner backing a promising customer. Then he hears that the AI lab is committing to buy enormous quantities of chips, cloud capacity, or data center build-out. He sees revenue, backlog, capacity expansion, and market leadership. The stock moves higher, analysts upgrade the target, the market cap expands. The same company now has even more highly valued stock and even more flexibility to finance another strategic deal. This is how circular enthusiasm becomes self-reinforcing. On paper, everybody appears to be winning at once. The model company gets cash, access to compute, and credibility. The chip company gets revenue, perceived scarcity, and a larger strategic moat. The cloud company gets a long-duration demand narrative. The data center builder gets tenants, financing, and a richer exit story. The private equity sponsor gets a physical asset tied to the hottest narrative in the world. The banker gets fees, The politician gets a talking point about national leadership. The retail investor gets a chart that seems to validate the whole architecture. What almost nobody asks is the only question that matters in the end. Who is earning a durable cash return on all this capital after the subsidies, circular commitments, accounting adjustments, promotional language, and leverage are stripped away? That question sounds dull during a mania. It sounds much less dull after the bills arrive. I have seen this movie before, and the dangerous part is not that people get excited. Excitement is permanent in markets. The dangerous part is when the financing structure is built on the assumption that future demand must be enormous, continuous, and profitable enough to justify increasingly irreversible infrastructure. Once that assumption gets embedded into land purchases, debt issuance, lease commitments, power contracts, server depreciation schedules, municipal planning, and public utility cost structures, you are no longer just speculating on a stock. You are remaking the real economy around a demand curve that may or may not fully arrive. That is why I tell people to stop using soft words for hard risks. A price chart can be a bubble. An overfunded system with circular dependencies, opaque marks, and huge fixed infrastructure can become something else entirely. Look at the way the incentives line up. If a company trading at an extraordinary valuation can preserve that valuation by proving that demand is insatiable, it has every reason to help create that appearance of insatiability. If a partner can sign an enormous contract and be rewarded instantly with a higher share price, it has every reason to stretch toward headline scale before economic scale has been proven. If an infrastructure operator can borrow against future AI demand and place the liability outside the balance sheet of a giant technology platform, the temptation is obvious. If private capital can buy land, build shells, sign leases, and ride the frenzy into marked up valuations, it will move faster than sober utility planning ever would. This is how financial engineering arrives, wearing the mask of technological destiny. You do not need a conspiracy to produce bad outcomes. Incentives are usually enough. Once people understand that, the loop stops looking mysterious. It begins with chips because chips are the visible bottleneck. They are expensive, scarce, and easy for the public to understand. Every system needs them. Every headline mentions them. Every company that wants to look serious about AI needs a relationship. So the chips become the center of gravity. Then the chips require data centers. Then the data centers require land, cooling, transformers, transmission capacity, construction crews, backup generation, and financing. Then the labs need revenue growth, or at least the appearance of a path to revenue growth, to justify all the compute being consumed. Then investors need quarterly evidence that the spend is productive, or at least evidence that everybody else is still willing to finance the next stage. That is the loop. Once you see it, you also see why the language around AI becomes so dramatic. It has to become dramatic. The capital intensity demands it. When billions become tens of billions and tens of billions become hundreds of billions, moderate rhetoric is no longer enough. You need civilizational language. You need inevitability. You need a race. You need urgency. You need a threat from foreign competitors. You need a promise that labor itself may be redefined. You need to convince everyone that not participating is more dangerous than overpaying. That is how giant spending plans stop looking reckless and start looking patriotic. The story does not end with technology companies. In some ways, that is only where the public story begins. Behind them sits Wall Street. Behind Wall Street behind private credit sits private equity. And behind all of them sits the physical world that does not care about PowerPoint. A model can be downloaded overnight. A server farm cannot. A chatbot can win headlines in a day. A grid upgrade can take years. A company can promise scale immediately. A power plant cannot be wished into existence by investor enthusiasm. This is where the black hole becomes easier to understand. Once the capital leaves the world of software narratives and enters the world of steel, pipes, turbines, substations, and industrial land, the reversibility drops sharply. That capital is no longer floating in imagination. It has become anchored in assets whose resale value depends on continued utilization, continued financing, and continued faith that the entire build-out still makes economic sense. That is exactly why I pay such close attention to private equity entering the data center business. It is not an accident. Private equity goes where a hot narrative can be attached to hard assets, leverage can magnify the appearance of returns, and liabilities can be distributed across structures that are less transparent than the public market. Data centers fit that recipe beautifully. They are tangible enough to finance. They are strategic enough to market. They are complex enough to make outsiders feel unsophisticated for asking basic questions. They are closely tied to the hottest spending wave on Earth. And they can be leveraged. That combination always deserves suspicion. Think about what is really happening. Private firms acquire or develop data center capacity. They lease it to hyperscalers or AI-linked operators. The technology company keeps some obligations off its balance sheet while still securing capacity. The private sponsor gets a story that sounds like long-duration infrastructure for the future of intelligence. Banks and private lenders finance the construction. Local communities give up land, power access, water, zoning flexibility, or tax advantages because the project arrives under the banner of progress and jobs. Everybody in the chain can tell a flattering story. What is much harder to determine is whether the returns are genuinely attractive once utilization risk, technology obsolescence, refinancing risk, political backlash, power cost escalation, and oversupply are recognized honestly. That honesty is often missing at the exact moment it is needed most. No manias advertise themselves as manias. They advertise themselves as common sense. The AI build-out is now sold as unavoidable. If you question the economics, you are told you do not understand the technology. You are told you are underestimating demand. If you question the community cost, you are told jobs and progress require sacrifice. If you question the energy burden, you are told innovation always has trade-offs. If you question the accounting, you are told the useful life assumptions have simply improved. If you question the financing, you are told scale winners deserve aggressive support. I have heard every one of those songs in different keys. They all sound intelligent until they run into arithmetic. And arithmetic is stubborn. A data center does not become wise because the word intelligence is attached to it. A server does not become immortal because management extends its depreciation schedule. A lease does not become safe because the tenant is fashionable. A debt stack does not become harmless because the asset class is strategic. A utility bill does not vanish because a project is exciting to investors. A rural community does not owe its landscape to financiers, simply because financiers have discovered a new narrative. This is where the public begins paying for a game it never agreed to underwrite. The infrastructure for AI is not being built in abstract space. It is being built in counties, suburbs, industrial zones, and once quiet areas that suddenly find themselves hosting giant power-hungry campuses. The cost is not only land use, it is transmission strain, water usage, local environmental burden, and eventually utility pricing. One of the dirtiest habits in modern finance is privatizing the upside story while socializing the infrastructure cost. That habit is very much alive here. If technology firms or their infrastructure partners were fully internalizing every cost they impose, the conversation would already be more sober. But when regulation, lobbying, rate design, and local politics allow part of the burden to spread outward, the project looks more profitable to insiders than it really is for the society carrying it. That is a warning sign, not a footnote. The public hears about national competitiveness. The public is less often told that utility upgrades, congestion, environmental fast tracks, and community compromise may end up absorbed by households who will never own the economics of the thing they are subsidizing. That has happened many times in American life. It is happening again. At this point, some people still want to reduce the issue to the old question. Fine, they say, even if the structure is aggressive, does it not still amount to a bubble? Why insist on calling it something darker? Because a classic bubble has a cleaner ending. In a classic bubble, the public market eventually stops believing. Prices fall violently, capital leaves. The bad projects die, the survivors emerge. There is pain, then reallocation. I think AI may contain a bubble in prices, yes, but the broader system has features that make the unwinding less honest, less visible, and more prolonged. First, there is no easy exit. When enough capital is committed to hard infrastructure, you cannot unwind neatly. You cannot casually repurpose giant server campuses, power arrangements, and specialized facilities the way you can sell a stock certificate. Once built, they need to be used. Once financed, they need cash flow. Once the debt is issued, the borrower needs continuation, not reflection. The machine demands more feed even when returns are unclear. That is black hole behavior. Second, there is no immediate truth. Private assets do not always reveal distress on schedule. Illiquid assets can sit on books at marks that lag reality. Useful life assumptions can flatter earnings. Capacity can appear valuable until utilization falls enough to force a true clearing price. Lenders can pretend. Sponsors can delay. Management teams can describe temporary softness while hoping the story heals before hard recognition becomes unavoidable. That means the public may not get one obvious alarm bell. It may get many quiet failures instead. Third, confidence can remain artificially high long after underlying economics weaken, because the strategic narrative is larger than any one quarter. As long as giant firms keep announcing commitments, governments keep framing AI as a national priority, and capital markets keep rewarding visible participation, sentiment can float above reality much longer than critics expect. That is why I do not think the end, if it comes badly, will resemble one cinematic explosion. It may look more like 1,000 small breaks hidden behind closed doors. Construction pauses here, a lease renegotiates there, a server generation ages faster than the depreciation schedule, admits a private borrower refinances at worse terms, a sponsor delays a mark, a startup disappears quietly, a utility dispute emerges, a community sues, a tenant reduces its demand growth, chip rental economics slip, a promised return on infrastructure does not arrive, a lender tightens, a project that seems strategic suddenly looks merely expensive. Then, months later, the public notices that far more capital has been consumed than enduring value has been created. That is how black holes reveal themselves. They do not always explode. Sometimes they absorb. The AI optimists are not wrong about everything. That is another reason the situation is dangerous. Some of what they say will be true. There will be genuine breakthroughs. Some companies will earn fortunes. Some tools will raise productivity. Some workers will benefit. Some industries will be rebuilt. Great technological shifts often arrive wrapped in excess. The railroad boom had real railroads. The internet bubble had the internet. The trouble is that real revolutions still destroy capital when too much money chases them through the wrong structures at the wrong prices. That distinction matters enormously. I can believe AI will matter for the next 20 years, and still believe a great deal of AI-linked capital is being allocated foolishly today. Those two thoughts are not contradictory. They belong together. A man gets into trouble when he thinks every powerful technology automatically justifies every financing scheme built around it. That is not investing. That is surrender. So let us think clearly about the possible outcomes. The happiest outcome is that the technology grows into a large portion of the expectations now being placed upon it. That does not require perfection. It only requires that enough valuable use cases compound into real durable cash flows that justify at least the strongest part of the infrastructure. Boom, we have seen versions of this before. The dot-com period destroyed oceans of capital, but real winners emerged from the wreckage and reshaped the world. Something similar could happen here. A great deal of spending may still prove excessive, but from the excess could come tools and companies that make society more productive and create real wealth. That is possible. It is also the scenario people cite most eagerly because it allows them to excuse almost any present extravagance as the necessary noise around future greatness. I am not comforted by that logic. The worst case is not simply a bad stock market outcome. The worst case is that AI becomes the organizing principle for a tighter merger of state power, corporate power, surveillance capacity, labor displacement, and capital concentration. People hear that and think only in science fiction terms. I do not. I think in ordinary political terms. Every powerful tool invites a struggle over control. Every period of fear invites justification for monitoring and centralization. Every system sold as necessary for national security tends to attract authorities who believe emergency exceptions should become ordinary practice. If intelligence infrastructure becomes both economically central and politically strategic, freedom can be pressured from two directions at once. People can lose bargaining power in labor markets, while states and firms gain new ways to track, price, rank, and influence behavior. That is not a fantasy. It is a human tendency furnished with better machinery. Still, I do not think the most likely result is either perfect prosperity or instant dystopia. The most likely result, in my judgment, is messier and more familiar. The world will keep spending because no major player wants to be absent from the race. Some of the spending will be productive, some of it will be waste. Some of the profits being reported along the way will be cleaner than others. A portion of the infrastructure will be genuinely useful. Another portion will prove too early, too expensive, too leveraged, or too optimistic. Because the spending wave is tied to strategy, prestige, and national rivalry, capital discipline will stay weaker than it should. Because many assets are illiquid and privately financed, truth will emerge slowly because governments now smell strategic importance. Public support will drift closer to the system. Because ordinary households are far from the decision table, many of them will absorb the second-order costs without sharing proportionally in the upside. That is why I call it a black hole. It keeps drawing in more matter because too many participants need the story to continue. Even skeptics accidentally feed it by treating it only as a valuation dispute that understates the structure. The question is not merely whether some stocks are overvalued. The question is how much land, debt, power, equipment, balance sheet risk, public subsidy, and political commitment are now orbiting around a demand forecast that still depends heavily on faith. Once a system reaches that point, traditional labels become too gentle. I pay close attention whenever accounting starts helping a narrative survive. It does not mean fraud by itself. It means management has encountered a helpful degree of elasticity in reporting and is using it. When useful life assumptions on servers or network gear get extended, depreciation falls and earnings rise without a single extra dollar of customer love. That kind of move may be defensible in narrow technical terms. It may also be a giant tell. If the most important hardware in the world is changing rapidly, becoming obsolete rapidly, and being pushed to greater intensity, then investors should ask why everyone suddenly feels more comfortable claiming it lasts much longer. An accounting change can flatter profits today while postponing economic recognition until later. Michael Burry has built a career by noticing when the paper story becomes too detached from the asset reality. I would not dismiss that habit lightly. That is the sort of signal mature investors learn to respect. Not because it proves doom, because it reveals pressure. Pressure creates behavior. Behavior creates clues. The public still imagines most great financial breaks are announced by screaming headlines and one giant collapse. Sometimes they are. More often, the clues were present long before the public chose to care. A financing loop here, a dependency there, a mark that seems generous, a useful life that suddenly lengthens, a capacity build-out justified by projections that rely on perfect execution, a lender comforted by fashion, a sponsor comforted by marks, a management team comforted by adjusted earnings, a government comforted by strategy, a public comforted by the idea that somebody smarter must be keeping score. That is exactly when independent thinking matters. I do not mean cynical thinking. Cynicism is lazy. It assumes every innovation is fake. That is not wisdom. I mean sober thinking. Sober thinking asks what return is being earned on the capital employed. Sober thinking asks who bears the downside if projected demand comes in weaker than expected. Sober thinking asks whether the economics would still look attractive if the promotional language were cut in half. Sober thinking asks whether communities are being paid fairly for what they are giving up. Sober thinking asks whether politicians are protecting citizens or simply subsidizing a race they do not want to appear to resist. Sober thinking asks whether accounting choices are helping illuminate reality or merely helping everyone postpone discomfort. Most of all, sober thinking asks whether the thing in front of you is built to produce cash or built to require more cash. That final distinction is the heart of the matter. A good business takes capital in and eventually throws more cash out. A black hole takes capital in and needs fresh justification to attract the next round before the prior round has truly proven itself. In ordinary times, markets punish that structure. In extraordinary narratives, markets celebrate it. That celebration can last a long time. One reason it can last is that AI is now moving from corporate fashion into state doctrine. Once governments begin treating the race for advanced AI as strategic national policy, the spending wave gains a second engine. It is no longer just venture ambition and public market enthusiasm. It becomes tied to national prestige, security language, industrial policy, and a competition logic that encourages overspending rather than restraint. If the White House or any other major state actor frames AI build-out as mission critical, then the black hole acquires fresh gravity. Politicians hate being blamed for missing a strategic century. They do not mind being blamed later for spending too much nearly as much. That asymmetry matters. Once the state stands near the table, a project can remain overfunded much longer than private prudence alone would allow. So where does that leave the ordinary investor, the worker, the homeowner, the ratepayer, the citizen who did not design any of this, but must live with it anyway? It leaves him with one responsibility. He must learn to distinguish participation from obedience. He does not need to reject every AI company. He does not need to deny the technology. He does not need to shout about apocalypse every morning, but he absolutely must refuse to surrender his judgment. He must understand that a strategic narrative can enrich a few while burdening many. He must understand that public excitement often arrives before economic proof. He must understand that circular funding can masquerade as demand. He must understand that private markets can hide stress longer than public markets. He must understand that communities can be told they are winning while they are actually paying. He must understand that a productivity miracle for some can still be a bargaining disaster for others. He must understand that every age invents a reason to stop asking old questions, and the old questions remain the most valuable ones. Who is paying? Who is profiting? Who is assuming the risk? Who is marking the asset? Who can exit? Who cannot? Who gets the upside? Who absorbs the bill? When I was younger, I learned that the world often rewards patience more than speed. But patience is not passivity. Patience only works when paired with clarity. A man who patiently sits inside a bad capital structure is not wise. He is simply slow. So I would approach this era with curiosity, but not worship. Learn the tools, study the companies, follow the power contracts, watch the data center economics, watch the depreciation assumptions, watch the private credit markets, watch the communities where the campuses rise, watch the utility rates, watch how often strategic partnership really means mutual dependence. Watch how often reported strength depends on another player in the same circle, continuing to spend. Watch where genuine customer willingness to pay appears and where spending is still being justified, mostly by expectation. In every cycle, there comes a moment when people stop asking whether something is good and start assuming that because it is important, every price and every structure, that moment is where discipline disappears. Discipline is what I would keep. I am not afraid of intelligence. I am afraid of leverage, opacity, circular incentives, socialized costs, and a culture that mistakes scale for proof. That combination has broken many people who thought they were participating in progress. It may create winners here too. Great winners, some of them will deserve it, but that does not cancel the possibility that an enormous amount of capital is being pulled into a system that has not yet shown it can return what is being asked of it until that question is answered honestly. I will keep using the harder phrase. This is not merely a bubble to me. It is a black hole built from ambition, financing, accounting, infrastructure, and power. And in markets, the most expensive mistakes are usually made not when people believe in something new, but when they forget that even the future must eventually answer to arithmetic.